Goldman Sachs is in the financial sector, and it's one of the cheapest stocks in the entire stock market. But fair value isn't always enough. As you can see by the long-term historical fast graph on Goldman Sachs, that the company's earnings have been very cyclical over time. You can see where they've had periods where they rose dramatically, then they collapsed, of course, in the Great Recession. They recovered, but then they collapsed again, even as bad or worse than they did during the Great Recession. But then since 2011 or so, they've had a pretty good record, but again, it's been very, very cyclical. So even though this stock is very, very inexpensive, fair value does not always mean that the stock is a good investment. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. Welcome you to another Subscriber Request Tuesday series. And I'm right now working on a series where I'm going to cover all of the 11 GIC sectors. And right now on this one I'll be covering is the financials. And the financials contain really some of the most undervalued stocks in the entire stock market. And the financial sector also is one of the most undervalued sectors in the entire stock market. So I'm going to go ahead and take a look at this because as I showed you Goldman Sachs a moment ago, let's go ahead and look at the S&P 500. Let's move back to our fast graphs. The S&P 500 is very overvalued. I've been talking about this in every one of these sectors. You can see the price is significantly above its historical normal PE or the what I would call the intrinsic value PE of 15 times earnings. So we have a very, very expensive stock market. And yet stocks like Goldman Sachs are trading at a very low valuation. They have an earnings yield of almost 15.61%. The earnings yield of the stock market is only 4%. So you can see there's a great advantage to owning undervalued stocks versus the stock market. However, you also have to basically calibrate your performance when you're doing valuation. So right now we're measuring a lot of stocks against the S&P 500 where it has an unfair advantage because of its great valuation. Now, out of the financials here, I've been hitting about 5 or 6 stocks in each of the other sectors I did. You know, the Global Industry Classification Standard, or GICS, was formed in 1999 by MSCI and Standard & Poor's Dow Jones Indices. And they developed these GICS sectors, and this is one of the 11 sectors. And as you can see here by this portfolio that I've built, I've got 38 basic financials that appear to be attractively valued, but not all of them necessarily, as I'll illustrate, are good investments. But remember, measuring performance without simultaneously measuring valuation is a job half done. But as I indicated, looking at earnings yield, Goldman Sachs offers as one of the most inexpensive. Unum is another one. So I'm going to go over all these stocks very, very quickly here. This is going to be a very high-level presentation. I'm not going to be, spending a lot of time analyzing each of these individual stocks. For brevity's sake, I'm going to just give you a perspective of what the businesses look like, how the stock price has tracked those business operating results over time, and whether the stocks are truly undervalued or not. Because as I'll illustrate with some of the examples, fair value is not always an indicator of a good investment. So let's go ahead and start. We're going to start with Allstate Property and Casualty Insurance. Allstate is an A- rated company. Earnings yield is 10.72%. Trades on the New York Stock Exchange, and it's one that we all basically know and understand. Allstate has been around and been on the television, for example, for a long time. But once again, I want you to look at the historical record. Very cyclical stock, came through the Great Recession and did very, very poorly for about 6 or 7 years there. And you can see the stock price really followed that. Then they started to get some mojo, but then recently, after coming out of COVID, they had the flash crash. The stock is trading, it's very undervalued, but we are not expecting good results for 2021 or 2022, and that's partially what's keeping the stock cheap. But if you're looking past that, if you're looking forward, then there is a chance that Allstate may be a great buy here, but you would have to be patient with it. But we're not giving it much long-term growth. So even though the stock is cheap, doesn't simultaneously make it a good investment. So I'm going to go through these stocks now very quickly with the same kind of logic that I've shared with you here on Allstate. So let's go ahead and look at the next one. This is AMG, which is a asset management and custody firm. This is a very interesting stock because, first of all, it's grown almost 10% a year. It has a little bit of cyclicality, but not quite as cyclical as what we saw with Allstate or Goldman Sachs for that matter. Coming into COVID, they had a couple of really bad years, and the stock market just really killed the stock. You could see it collapsed. Now, here's a case where you had a great speculation because you had a good company, a triple B plus rated company that had good earnings growth, averaging about 10% a year, had a couple of bad years, and the market crushed the stock. But look at the recovery. Look how the stock price is now moving back to the mean. The company doesn't pay much in the way of dividends. It never really has. It did pay a small dividend for a couple of years. So this is more of a growth stock. But the earnings yield is 11.58%. The company is very, very attractive here if you're looking for growth and capital appreciation and don't mind a little speculation. That would be AMG. The next one here is Brookfield Asset Management. Now, I really like this. Now, this is a U.S. listed and Canadian listed company. So here we're looking at it from a standpoint of Canadian dollars, CAD, Canadian dollars, and I'm going to go ahead and look at it next in the case of U.S. dollars. So you see a lot of similarity between these two stocks here. What you're looking at is the exchange rate is what's making these things look differently. But here's the thing, whether you're looking at US dollars or Canadian dollars, even though this stock is trading at a PE below 15, which I talk about all the time, and even though the earnings yield is 6.94%, that doesn't simultaneously make this a good investment here because you also have to look forward. You can learn from the past, and you can learn a lot how this business has performed in the past. But when you're investing, you want to invest in the future. And the future looks like 2022 is expected to be a very bad year. So you want to be very cautious investing in this one. You might not want to look at it until the end of next year, for example. All right, moving on here to go quickly. Here's Bank of New York Mellon, one of our better U.S. banks, A-rated. Earnings yield 6.55%. It's 2.14% dividend yield. This stock is just on the threshold of what I consider to be attractive value. But notice how, again, the business has periods of, rising earnings and then cyclical dropping earnings. They did drop earnings from the COVID, and the stock got very inexpensive, but has since recovered. But look at the clear long-term correlation. But Bank of New York Mellon would be what I would call a fully valued, not necessarily a real inexpensive stock, but it does trade at fair value at least. And there's a lot of stocks in today's marketplace you can't find at fair value. Now, Bank of Montreal is one of the Canadian banks. Interesting about these Canadian banks, and this is what the advantage of fast graphs gives you. You can look at these, and the current earnings yield is 8.6%, and the PE is 11.57. But I want you to notice the historical normal PE has been 11.67. So these stocks do trade at a discount. Now, this is, again, the Canadian version we're looking at here. But you want to buy this at about 11.5 times earnings or so. So again, this stock is attractively valued, offers a 3.5% dividend yield. It's an A-plus rated bank, one of the major Canadian banks. And, looking at it in its U.S. counterpart, you see very, very similar metrics. The PE here is a little bit higher, about 11.7, but still below 12. And the stock, based on U.S. currency, looks a lot more attractive than it does when you look at it from the standpoint of the Canadian. I go back to the Canadian. Both look attractive. They both are attractive. But, right now the U.S. version looks a little better, 2.87% earnings yield. But once again, notice how the stock has really tracked the blue line in this instance. The fast graphs is the fundamentals analyzer software tool to think with. You want to look at what you're seeing here and evaluate it. And so you wouldn't, even though the 15 PE ratio is what I would consider this stock could possibly be worth as a company that's grown at 8.85% and has a dividend yield of 2.87%. Note that the market has continuously discounted the valuation of this stock, and you should know that. Now, Bank of Nova Scotia is another example, very similar to what we just saw. Normal PE of around 12 times earnings, trading at 11.7 times blended PE now. Dividend yield is over 4%, which makes it attractive. Earnings yield about 8.35. That's the Canadian version. Next is BOK Financial Group. It's a regional bank. You can see, look at these beautiful correlation between stock price and earnings over time. The point is, when you see a stock that's undervalued, you can trust that it's going to move back into fair value, but you also have to forecast what future earnings are going to be. And right now, future earnings do not look good for BOK Financial for at least the next year or so. So this would be one that appears to be very cheap, has a very high earnings yield, 1.8% dividend yield. It's a triple B plus rated bank. But because earnings going forward look like they're going to be troublesome, this would be one that you might want to avoid. Valuation looks attractive on the current basis, but not so attractive on the future basis. That's the lesson I want you to learn. Here's the Canadian Imperial Bank of Commerce, again, another Canadian bank. You can see 8.7% earnings yield, normally trades at around 11 times earnings. You can see that very, very clearly, rather than the 15 PE ratio that you would think it should. The earnings yield is 8.71%. Stock is A+ rated, does offer a 3.6% dividend yield. I would call this one fully valued, relatively speaking. Here's Co-America. A very interesting graph here because you can see how important the operating results of a business are relative to what the company's stock price does in the long run. You can see a collapse in earnings here, a collapse in stock price, a very strong reaction when the earnings recovered. Low PE ratio, 12.42, blended PE, earnings yield 8%, 2.69% dividend yield, BBB+ rated, but earnings are expected to be down in 2022. As a result, if that is true, this stock could not be very attractive as a purchase right now, even though the valuation makes it look attractive. So keep that in mind. Here's Credit Argoli. This was a very interesting company here. I'm going to go into the corporate website here just so you see. It's a French company, all right, a French credit company. So I did go ahead and include it. You can see that, the business didn't do too much coming out of our Great Recession, but of course this is a French bank. It didn't go through the same recession of ours. The company doesn't offer very much growth if you shorten this time frame to where we can actually see earnings growth, about 4 or 5% earnings growth. It does have a 4.5% earnings yield. It's an ADR. It is A+ rated. This would be something you might want to look at for income. It's not necessarily a good investment from a standpoint of, capital appreciation, but it did generate about an 8.5% return. And remember that we're looking at a period of time when the stock market is overvalued, so comparing it to the S&P is not necessarily a fair comparison, in my opinion. Here's Discover Financial Services, blended PE of 7.28, dividend yield 1.57, very, very inexpensive, trading at a PE of 7.28, normally trades at 11.5 to 12 times earnings. So you can see, even though earnings are expected to be down, this one is inexpensive enough that it could make sense to start taking a position. And, this is what a margin of safety looks like. So, if the stock gets back to normal, you got a 52% potential rate of return. If it gets back to a normal PE of 15. If it gets back to its normal PE of only 11, you've got a 22% rate of return. And that's probably what I would focus on if I was considering this company. It's a very, very inexpensive company. Doesn't offer much in the way of dividend yield. It's BBB- rated. Next one we're going to take a look at is Fifth Third Bancorp. Once again, the relationship between earnings and price, in other words, how the business performs as a business and what the price does, is very, very profound and important. Coming out of the Great Recession, it kind of got its mojo on. It did suffer during the COVID flash crash. The stock price collapsed. It has recovered strongly. Again, notice that a lot of these financials, a lot of these banks and regional banks are expected to have a bad year in 2022. I believe that's related to the fact that analysts are expecting interest rates to increase, by the way. But here we got a blended P of 13.5. The stock normally trades at around 14.7 times earnings or close to 15. So this one would be reasonably valued with a dividend yield of 2.38%. But again, we don't expect much in the way of operating performance this year, so it may not be a great buy. Goldman Sachs I covered for you in the beginning, so I'll skip that one. Here's Hartford, and you can see Hartford coming into the Great Recession. The financial debacle was growing very well. The stock price tracked that. It collapsed, earnings collapsed, the dividend was cut dramatically. But since the Great Recession, the stock has basically been performing pretty well with about a 12% growth rate. Historically trades at around 11 times earnings. It's a little bit higher than that right now, so you would call this one fully valued. 2.13% dividend yield. It is BBB+, but it is the Hartford, and it does have better growth forecast because it's in multi-line insurance now rather than banking. So we've got good growth potential on this one going forward, and it could look, real attractive whether you're looking at it from a standpoint of its normal PE or its intrinsic value PE that I like to look at. Next one we're going to look at here is IA Financial Group. It's a life and health insurer out of Canada. Once again, you see normally around a 12 multiple on this stock. It did suffer during COVID, during the crash, but it's been recovering ever since, moving back into alignment with that blue line, and that would be the normal multiple over the last 5 years has been about a 10 multiple. The normal multiple over the long period of time, however, has been just a little bit higher than that, around 11 times earnings. In other words, if you look at the long-term picture here, it's been about a 12.6 times earnings. So if we were going to the forecasting graph here, I just want to make a point, and we're going to look at the normal multiple. We could go and find the long-term normal multiple of somewhere around 12. I'll do 12.2 here. So this would give you an indication of what kind of rate of return if this stock simply moves back into its normal, multiple that the company has historically traded at over the long run, rather than these last 5 years, which included COVID, which was kind of an aberrant period of time. The next one is Oryx Corp. Again, you see the relationship between earnings and price. I think these are so profound. The real beauty of fast graphs is to be able to look at these companies and just see how the business has performed and not just look at these statistics. Blended PE about 11.6. Normal PE has been about 12. 2.76% dividend yield. The company is A- rated. This is one that's very, very inexpensive and could be, very attractive going forward. Looking at it even through the, lens of the normal multiple, again, we'd want to look at not the normal multiple of 7, but 12.8. I want to focus on this because when I'm looking at forecasting here, the normal multiple has been very, very low because this automatically defaults to the last 5 years. But if you go use a more realistic normal multiple for this stock, over a longer period of time, 10 or 11 or 12 would be more normal. And I'll go ahead and be conservative and use 11, and this would make the stock look attractive. You're trying to analyze this and try to make rational decisions by evaluating what the historical information gives you. Very low valuations over the last several years, as you notice now. If I shorten the time frame, the PE drops from 12 to 8, and now the stock would look overvalued on that basis. You have to make those decisions for yourself based on the data as it's presented, and then try to evaluate why that data is presented the way it is. The next one I'm going to cover here is JP Morgan Chase, one of the better A- quality banks, diversified bank. It went through the financial debacle better than a lot of them did. And since it's come out of the financial debacle, if you look at it for the last 10 or 11 years, it's been growing at double-digit rates, been averaging about a 12.49 PE ratio. It's currently trading at a 10.37. It is expected to have a bad year this year again, but then it is expected to be better than a lot of the other ones that I showed you. So JP Morgan with a 2.5% dividend yield does offer decent total return if you're looking at 3 to 5 years from now, and it's obviously one of our highest quality banks out there. KeyCorp is a very strong regional bank. Again, you see how earnings, really collapsed coming into the financial debacle of the recession of 2008. It kind of took them a couple of years to get their mojo back, but then since then, the company's been performing pretty decent, averaging about 9% growth. Again, I want you to notice, expected to have a down year this year. Cheap is not always the ultimate answer. I believe in valuation, but it's valuation in incorporation with growth. For example, here's Morgan Stanley. You can see the relationship between earnings and market price over the long run. The company's done very, very well since coming out of the recession. Its earnings growth has averaged almost 16% a year. The performance, the stock was reasonably priced then. The performance is correlated very closely to that. It's outperformed the market on both dividends and total rate of return. Morgan Stanley at a 2.8% dividend yield, blended PE of 12.5, and an earnings yield of 8%. Could be a very, very attractive, one of the most attractive financials you want to look at. But keep in mind, if you're looking for total return, because it's got almost a 3% dividend yield, but it also has growth. But even Morgan Stanley is expected to have a bad year this coming year. So keep that in mind as you're looking at these financials. Don't get caught up by just the statistics. Statistics don't lie, but statisticians are darn liars is one of my old favorite phrases. Here's the M&T Bank, another regional bank. You can once again see how price tracks earnings. The stock has recovered strongly in 2021. Again, is expected to have a bad year next year. 2.59% dividend yield, blended PE of about 13.5, earnings yield 7.38%. Company's BBB plus rated. It's one of the good regional banks. Keep in mind, these stocks have already recovered dramatically. I've been talking about financials for about a year or two, and they're still cheap, but they're not as cheap as they were just a couple of years ago. Here's Nomura Holdings. I just kind of included this one because I wanted you to see the contrast of what to look at. This is an international stock. People are always asking me about international stocks and when Fastgraphs is going to be adding them. We will be adding them at some point in the future. This is clearly a Japanese bank, and I do want you to see how the stock price has really tracked what I would call the very cyclical, very erratic performance. The numbers look good. PE ratio under 10, earnings yield almost 10%, dividend yield 3.8%. It is expected to have a strong year going forward, but you'd have to take your pause by looking at the erratic dividend record as well as the operating record historically. But I thought this would be one that would be interesting just to go ahead and include. Principal Financial Group, I personally long this stock. I've been buying it when it was cheap here. It's still inexpensive. Normally trades at around 12 times earnings since, coming out of the recession or long term. The last several years, the PE's been about 11 times earnings. It's trading right at that range right now. Offers a 3.3% dividend yield, and again has good growth prospects. It's life and health insurance, expected to do better than what the analysts think most of the banks, as you can tell by going through this presentation with me. I'm going to start going a little quicker. Here's PNC. When I first ran this screen, this one was inexpensive, but the price has run up a little bit. It now has an earnings yield under 6%. It's trading at almost 17 times earnings. This is a case where undervaluation was very attractive in the last year or so. The stock is expected to grow over the next couple of years, but the price now has made it, I would say, less attractive because it's already gone above its earnings justified valuation line. Trying to move a little quicker here. Here's Prudential Financial. Prudential Financial, has been very undervalued for a couple of years now. COVID, it really took a big hit, but it's now starting to move back into fair alignment. Offers almost a 4% yield, 8.4 blended PE, 11.88% earnings yield. The company is A-rated. I think it's a very attractive opportunity, and I believe you could still accumulate Prudential here in this market. Royal Bank of Canada, one of the other Canadian banks that I've talked about, probably one of the more expensive ones of all the ones that I've covered. Here's the U.S. version, and that was previously the Canadian version. Over a 3% dividend yield, blended PE of 13.5, earnings yield of about 7.4%. The next one here is Sun Life. Sun Life is a life and health insurance company, one of the higher quality ones, A+ rated. Went through some issues coming out of the recession of 08 and 09. You can see how the price tracked at around 15 times earnings. Traded really at 15 times earnings quite a bit. The normal PE has been 13.7. If I shorten the time frame, it's down to about 11.7 or 12. But notice how it does touch 15 times earnings. So I don't think it's illogical to believe that this stock could go back to 15 times earnings and give you a greater return. And if it doesn't, if its normal PE stays around 11, it still offers you a 7 or 8% long-term return, earnings yield 8.3%, blended PE at 12, dividend yield 3.3%. Here's State Street Corporation. State Street is one of the better asset management and custodian firms out there. They've got a good record. The market used to really like to highly value this stock, but of course it got caught up in the financial situation, but a lot less than a lot of the financial stocks did, if you'll notice as I went through this for you. Short in the time frame, been growing about 8.5%, 9%, trading consistently at that 15 multiple. It's trading at right now at a 14 multiple. There's some upside here. Earnings growth is expected to be strong. Does offer a 2.2% earnings yield. I think it's a really excellent choice in today's market because of, again, the future expectation of growth going forward. Looking at Toronto Dominion, another one of the Canadian banks. Notice how similar they all look. Again, fully valued in the Canadian dollars. Here's the U.S. version, fully valued in the U.S. version as well. Earnings yield 7.6, dividend yield to 3.1. These aren't bad investments here. They're just not optimum from a standpoint of buying it at, really when the fair value. Here's Truist Financial. It's another regional bank in the U.S. Look at the relationship between earnings and price. You can see the history of the company. Since the recession, this company's been really performing pretty well as a business, averaging over 6% rate of return. Normally trades at 15 times earnings, dividend yield 2.8%, and it's A- rated. That's a plus to me. Here's Travelers. We all know who, and are familiar with Travelers. You can see the cyclicality of the earnings. The price kind of tracks that, trading at 12.96 times earnings yield over 7%, A-rated company, 2.16% dividend yield. This is just a good buy today. It's not necessarily, extremely cheap like it got here coming out of COVID. This would have been a great time to buy Travelers. But you can see the financials are generally inexpensive. UMB Financial Corp, you can see the stock has rallied strongly. It is expected to have a down year this year. It's another regional bank. The market has really priced this one at a premium quite a bit. So you want to, when you're looking at this one, you can, take that into consideration as well. And you can see the strong recovery here. But yet the numbers really aren't that great when you've got other choices in the financial sector. Here's Unum. It's one of the least expensive stocks, I think, in the overall marketplace. The company is BBB rated, dividend yield of 4.2%, blended PE of 6.43%, earnings yield over 15%. It's second only to Goldman Sachs in terms of earnings yield. I believe this stock is worthy of speculating on. I just think it's so inexpensive that no matter what, how you measure it, it's just so cheap and is expected to grow. At some point, I believe the market has to wake up and start pricing this stock according to the operating results that it's generating, which support a higher stock price, in my opinion. Here's U.S. Bancorp, one of the higher quality A-plus rated regional banks, or it's actually a diversified bank, U.S. Bank. You can see how the price relates to the earnings. We had COVID. That's, kind of gave us, this kind of issue in all of them. It is expected to have a down year this year, but the stock is cheap enough that it could even be attractive as a speculation, even with the earnings, going to be down this year. But again, I would be careful because of that. So the stocks are down. There you have it. Tough sector to do. I hope you enjoyed this video. It's kind of a long video, I know, but I just wanted you to see the similarities and how the sector really relates to how these stocks performed, how their businesses performed historically. That always becomes very important when you're making investment decisions, and then focusing on the growth going forward is critically important as well. Anyway, this has been Chuck Carnwell, aka Mr. Valuation, saying thanks for watching. If you like the video, give me a like, ring the bell so you get notified of future videos. Take a look at Fast Graphs, and at the bottom of this video, there are links to all the other videos in this series if this is just the first time coming to it. You might want to take a look at Fast Graphs too. You can see how much information they give you at a glance about the businesses that you're considering investing in. Thanks for watching.